All right, everybody. My name is David Garfinkel. I'm at Index Cooperative. I lead DeFi partnerships. Super excited to talk about RWAs today. Luckily, I've been able to work with everyone sitting up here, which has been great. But yeah, let you guys get started and sort of introduce yourself, maybe talk about why you're into RWAs or how your protocol integrates them.
Sure. Hey, I'm Sam, co-founder of Phoenix Labs, which started up recently, like 2 months ago. We are building the Spark protocol, which is DeFi lending market. But for the relevance of this panel, I've been involved in MakerDAO on the protocol engineering team, building smart contracts, maintaining the protocol and all that kind of stuff. I haven't been directly involved in real world assets, but I understand what's going on from the Maker and DAI perspective. So I can speak to them and how it's relevant to Maker from that perspective.
Hi, I'm Cynthia, founding partner and COO of Matrixport. Matrixport was established 4.5 years ago, more known as a TradFi crypto asset manager. So on our platform, we actually offer more than 40 different categories of yield products to the investors. A lot of you sitting here might have various interaction and collaboration with Matrixport from those regard. And this year we have launched a new brand called Matrixstock, which 100% focuses on RWA, because I believe RWA is where the new yield is going to come from. And because of the composability of DeFi, it's very exciting to bring the real world asset onto DeFi.
Hey guys, Erwan here. I work at Bakkt. I've been with the company for almost 2 years now. Involved in operations and distribution, but I've got a traditional finance background, doing sales and trading for banks and brokers, and been a hobbyist in the space for a number of years before transitioning professionally full-time into crypto.
Thanks for having me here. My name's Irene. I am head of strategy at Layer 0 Labs. Layer 0 is an omni-chain interoperability protocol, and we're also the builders of Stargate Finance. We are working with a bunch of projects that are in the RWA space, and certainly spend a lot of time with stablecoin issuers. And I'll speak a little bit to how we view stablecoins as right now the leading RWA in terms of product market fit. But yeah, thanks for having me. And I do apologize. I probably have to head out earlier than these 3 or 4, but you're in better hands with them.
We'll certainly be talking for long enough, so not too worried. So like I said, I work at Index Cooperative. We're sort of like a layer on top of all of these protocols and teams here. We've been building a real world asset index for over a year now. We're hoping to launch the end of this year. It's been super interesting to see it go from basically nothing to so many products we have today. I'd like to start with you, Cynthia. You guys are building an RWA product. What category is it in? What other categories are there? I mean, it's just saying real world assets is like a bit of a misnomer because it's really everything. So yeah, could you start with that? What is Matrixstock, and like within that, what are the other categories of RWAs?
Yeah, so this year, the first product we launched by Matrixstock is a short-term treasury bill token called SDBT. The reason we came about launching this is really because there is a vast market cap of stablecoin sitting there, 130 billion. And a lot of that last year was getting yield from all sorts of TradFi platforms like FTX, Genesis, and all this, doing lending and borrowing. As we all know that people then realize there's too much risk involved in it. There's too much counterparty risk you are taking without knowing, right? So with all those blow-ups, actually a lot of these stable coins are put not in use and it's underutilized, while at the same time you are seeing the rate hike by the Fed. So I think there's apparent demand that people want to have an on-chain version representation of the treasury bill, at least earn that 5% risk-free interest without the hassle to handle with all the off-ramp, on-ramp, trade execution, settlement, all those kind of things. I think that is just why we come up with this product. I just think similar logic would apply for other real world asset as the people's appetite and the market cap of our industry grow. I think more and more people want to get access to the real world yield without needing to off ramp, right? That's how we expand the scope, the use case, and the market, the product varieties and the target audience of our industry. Yeah.
Thank you. Yeah, I mean, I totally agree. It's tough when lending USDC on Aave gets 2%, but Treasury bills get 5%. There's obviously a difference there. We say the risk-free rate, but obviously there's smart contract risk and all that once you get on chain. But yeah, for us, like we look at it as public credit and private credit. The private credit side seemingly been around for a few years on chain with things like Centrifuge and Goldfinch. The public credit to us, though, is we think every on-chain team that's holding USDC should probably have liquid treasury bills as well. Bakkt has been working on this for a long time. Could you go through some of like the regulatory hurdles that maybe got you there? Like, for example, Bakkt isn't available in the US. Like, why is that? And like, what's the process for you guys going from off-chain fund to on-chain Bakkt token?
Sure. So, like regulatory hurdles, obviously in like tokenizing those traditional assets, legal issues is probably like the number one hurdle. Those like projects like Matrixport and ourselves face, yeah, it's all question. It's a matter of like trade-offs. Which customer base are you going after? If you want to serve US customers, then you know you will abide by the US laws, and that will constrain your ability to have permissionless or permissionless assets. So we chose, you know, we chose to have our model when we built the company was Circle and their USDC. We wanted those assets to be able to like move freely in the blockchain and to be as composable as possible with DeFi, so that guys like you know, Index Co-op or others could build products on top of that. So we chose Switzerland as a jurisdiction to incorporate the company and its issuer. So that, you know, that gave us basically a legal framework to build those assets, and for them to be able to be bearer assets and trade permissionlessly in DeFi.
Yeah, fair enough. When you say permissionless, still goes through the KYC process, correct?
So it's very much like Circle with USDC, i.e. the primary market is a permission market. So people that want to mint and redeem tokens through us have to onboard with us. They have to go through KYC. Transactions have to go through, you know, AML. But then the tokens that we issue are plain ERC20 tokens. So they can move freely and be transferred freely. So yeah, that's why, you know, or how permissionless they are.
Got it, got it. Yeah, when we say permissionless in DeFi, sometimes it means different things when we talk about RWAs. Cynthia, you had mentioned to me earlier today that Matrixport's product is actually liquid on Curve. Could you explain some of that? And maybe like also, just as an anecdote, there have been RWA products that have been traded on places like Curve that have had problems keeping their peg or have traded at a discount and stuff like that. So could you explain how it trades on Curve and like maybe what that difference is between buying it directly through Matrixport?
Yeah, sure. So I think what we are addressing is on-chain liquidity, right? We want to give instantaneous liquidity to people. That's a very important user experience. Because when you mint or redeem the treasury token from us in the primary market, it takes T+3 or T+4 days because all those operational hassle need to happen offline or off-chain, right? And that's if you are minting like 20 million, of course, that's it's okay to wait for 3-4 days. But if I'm just a client, I want to mint like 5K SDBT, and you ask me to wait for 3-4 days, I probably don't want to do it, right? So I think and also from the DeFi integration perspective, if you ever want to integrate your token into other, for example, lending protocols as a collateral, or use as a collateral for certain DEXs, or be used as a yield component on other on-chain on-chain asset management protocols, you need to be able to allow them to liquidate, right? And risk management, and that's why instantaneous liquidity on chain is very important. That's why we build a curve pool where it's basically provided 24/7. So people ask, okay, you are STO, you are not ERC20, you are ERC1400. Why you can have that kind of curve pool? Does that mean it's really permissionless? It's not. The token itself, format itself, is ERC1400. So there is it's like ERC20 plus certain restrictions, controls, right? And I think Curve can support that token that token format as well. So if you are already in the whitelisted address where you are already KYC'd, accredited investor, validated, you can interact with the Curve pool to buy or sell. Maybe just one SDBT. That's also doable on Curve. So I think the DeFi infrastructure is neutral. I think in the future it should support multiple token formats, and the token format will give different level of permissionless, and then the infrastructure just function as an infrastructure. So I think we are making a good example on how permissions pool can be set up on Curve and still be active and growing in liquidity.
Yeah, there certainly will be more permission pools, hopefully on most DEXs. Curve is a good example. Yeah, the piece of instant liquidity is like the new paradigm of crypto that I think's incredibly important. I'm curious, like when you look at like not so much new tokens, but like the instant liquidity you get of like a flash loan on Aave. Like obviously T-4 days isn't going to work when you need the token back in the same block. So like for us, like if it's not instantly liquid, it's probably not DeFi like the way we think it is. It's not interoperable through all these DeFi protocols, then you might as well just have it sitting off chain. I wanted to switch conversations a little bit just as we talk like what these sectors of RWAs are. To me, the biggest and seemingly obvious, the biggest RWA is USDC. Could you just give a little bit of background how makers use USDC, and then how that's been like a pass through with RWAs to like the DSR, for example, that you guys build on top of?
Yeah, sure. I would say the biggest is Tether, though.
Yeah.
But yeah, USDC. So yeah, Maker has had reliance on USDC going back to March 2020, which we call Black Thursday, which was the event where ETH, there was, the COVID lockdowns. ETH price crashed about 50% within a day. It was a very massive drop. The Maker protocol was only like 4 months old at that time. So like there was like insolvency that had to be recapitalized by minting new Maker, and the protocol was like this close to being shut down and settled. So anyways, as a repercussion of this, previously Maker or DAI had been trading below peg consistently. So we were raising the rates to have people close out their leverage loans, and then to bring the DAI peg back up in line. The opposite happened after this, where there was more demand for holding DAI than there was for taking leverage on the other side with ETH. And so the DAI peg broke up actually quite significantly. It broke up to even 10 cents above $1 basically. And so there were efforts to try and rein this in using just ETH, but ultimately the strategy failed. So the decision was made to onboard USDC at that point, because there's really no other asset to bring the peg back down. So at that time we onboarded USDC. We onboarded as user vault originally. Then in December of 2020, the peg stability module was introduced, which actually I built. So that was a one-to-one swap with between USDC and DAI, and so there it basically opens up an arbitrage that would force the peg back down to $1. So since then, demand for DeFi summer was in full swing, and the whole crypto market exploded. So DAI market cap went huge, and ever since March 2020, the demand for holding DAI has outpaced the demand for crypto leverage, and it's been that way ever since. And so the crutch we were using was USDC, and DAI was pretty heavily backed by USDC at various points, which is fine. I have no problem with Circle, but we're aiming for a decentralized stablecoin, so we want to diversify the portfolio backing it. So over time, Maker has been working on this diversification, and the obvious choice now in the past year has been T-bills. So Maker's been heavily ramping up treasury bill investments. First major foray into this was November of last year through Monetalis, MIP65. It's we don't have to get into the technicals, I guess. Anyways, it was a direct treasury investment, first buying ETF, I believe it was BlackRock IBO1, and then and actually it was a mix of a few things. But yeah, basically short duration treasuries in an ETF. That was ramped up to 500 million earlier this year. That package was then subsequently ramped up to 1.2 billion, which was switching to a laddered direct treasury investment strategy. And now we have a duplicate of this under a new proposal that just passed recently, another 1.3 billion, which is removing the stablecoin backing, which was USDC, Paxos, and Gemini USDC, Gemini USD. And so because those are, those are backed by T-bills as well. It's just they're not paying Maker, so might as well get paid for the same backing. So yeah, diversification more directly into the underlying assets. Now that's not to say that Maker is not just yield maximizing and nothing else. Like DAI needs to maintain its pegs, so USDC and USDT are still very, very liquid on chain. So Maker uses those for maintaining the peg, and for that purpose, it's worthwhile maintaining some inventory in USDC and probably and Tether as well soon. We don't have any Tether backing right now, but that's changing. So yeah, USDC is still the primary peg making mechanism.
Got it. Understood. Thanks for explaining the MIP 65 is definitely like important. No, but it's like it was an important turning point in DeFi, in my opinion. Before we get off that topic, could you explain a bit of like the underwriting process for how you guys maybe go about allocating to some of these positions? Like T-bills can be relatively easy, but you guys have financed solar farms in the past, things like that. What's the process? You guys have like a working group for that, or I know Maker's changed a bit in the past couple months. So if you could explain like how that goes from underwriting to tokenization.
Yeah, okay. So, and let me preface by saying I'm not on the RWA team, so I kind of watch this stuff from a distance. But yeah, there was originally a real-world asset core unit. For those unfamiliar, MakerDAO is actually operating as a DAO, so there's like no legal entity. So the workforce was organized into what are called core units, which are specialty segmented teams. So like, for example, I was on the protocol engineering core unit. We build smart contracts and stuff like that. So there was a real world finance core unit, which was led by my colleague Seb, who's actually around here at the conference. So he was running that, and there was like lawyers and stuff like doing the underwriting on the various products that were being invested into. This was mostly small scale up until about last year. So like I think the biggest deal was Huntington Valley Bank at 100 million. But yeah, it was really sort of more of a trial thing, as most of the income was coming from DeFi. But now that we're in a high rate environment, DeFi rates have gone to the floor basically. It makes sense to be ramping, like getting serious about these RWA investments. So the T-bills is definitely like the vast majority of the RWA exposure. both directly and indirectly through fiat-backed stablecoins. But yes, there is the underwriting process. Yes, there's like lawyers and stuff that we're doing the review. Right now, Maker's in a transition, like a governance transition period. So the sub-DAOs, and I don't know how much you want to get into this, but
I'm happy to get into it. We're a participant in many of these, so happy to talk about it. But yeah, this whole process is like unknown to a lot of people. So yeah, certainly would happy.
Sure. Okay. So Maker Core, previously DAO was a very flat structure, and the governance ended up in a very politically is basically like very politically driven, which was not great for running what I view more akin to a business. But anyways, for better or worse, that's what it was. So Rune, the co-founder of MakerDAO, has put forward the endgame plan, which is to lock Maker Core down into just very basic functions and have all the innovation and growth and balance sheet allocation move out to what are called sub-DAOs. So these are like recursive, smaller versions of MakerDAO. You can think of them like that. And they have their own treasury surplus, and they have their own revenues, and Maker just charges them a certain cost of capital, and then they're free to deploy into whatever. There's obviously rules about what to deploy into, but as these sub-DAOs build more and more of a junior capital position, they can then be more free to experiment as they're underwriting more and more of the credit that's going out. So it's sort of this tiered system, and this is not in place yet. The sub-DAOs will be launching next year, but this is the idea.
Yeah, certainly exciting. It was interesting when we went from go on Maker Forum to now it's Maker Forum with 5 different sub-DAOs, which was cool to see. Irene, I have a question for you. So we're talking a lot about RWAs. Many of these are on Ethereum. How do we get these cross-chain? How do we get these into the hands of regular users that don't want to pay $10 gas fees?
Yeah, I mean, I'll start by saying that when I think about a year and a half ago, I was in New York and I went to a debate that was happening with like a prominent advocate of cryptos, is what I'll say, and a very, very bearish software tech VC. And they were on stage and they were debating the topic of use cases for crypto. And the proponent said, like, tokenized real estate. And obviously in a crowd full of software tech VCs, everyone like booed. And they're like, no one cares about that. I think that's really, really cool, but there just isn't actually market demand for that right now. And I think, 3 years ago, everyone was really excited about RWAs and had all of these really, unique and novel use cases for it. But where there is demand right now is lower risk, high yield, like tokenized assets like T-bills. And so I'm particularly excited about that. However, now that we're at this place, we have to figure out how to make it even easier to bring in new users. So like, yes, we can serve current crypto native users, but we also want to bring TradFi to DeFi rather than DeFi to TradFi. And I think making these tokens accessible via L2s is really important for that. And L2 to L2 movement there is incredibly important, and also layering things in like account abstraction. So you asked about how to bring these cross-chain or omni-chain. With some of the projects that are integrating layer 0, they are now converting these tokens into OFTs, which are omni-chain fungible tokens. It's a way to mint tokens that are native on multiple chains and allow for seamless movement between them just by paying gas fees. So not going through a wrapped asset bridge or a very clunky process that involves multiple gas tokens, multiple clicks. And also, it's interesting, the most high volume pathways across the layer 0 messaging protocol are Arbitrum to Optimism, Optimism to Arbitrum, like L2s to L2s. That's where there's so much product market fit. And so we're really, really excited about that. I think over the next 6 months, there will be rollouts of particularly exciting RWAs that will have product market fit and will be OFTs. And of course, as I said at the beginning, I think the highest product market fit version of these is stablecoins. And I spoke yesterday on a panel about stablecoins in a multi-chain world. So that's something that we are super keen to see. And I think also for me and in the work that I'm doing leading strategy at Layer Zero, trying to explain how the blockchain tech stack is actually superior to the current tech stack for all of these financial products is really important too. It's just actually better for regulators and people in TradFi to utilize blockchain technology and interoperability embedded into that, because it's easier to audit. There's instant settlement, the composability aspect, and like opening up the pathways across different like nation states, for example, and using all of this. So we're really excited about it. I think OFT in particular is purpose-built for these kinds of tokens, and I will be really keen to see reception to what's coming out over the next few months.
Yeah, definitely agree. I think a lot of us think from like a DeFi perspective, how do we get Ethereum stuff and how do we move it over to these layer 2s? But like you said, like Optimism to Arbitrum, Polygon, ZK EVM to Arbitrum, like things like those are going to be super important. OFTs are something I'm familiar with at Index, but from looking at like a wider view, and this is why I asked you the question, Cynthia, about liquidity. Like, if these are KYC tokens, for example, like how do we get them cross-chain? Like, is this going to be a world where like, okay, some things are going to be permissioned, they may not be allowed everywhere? This is certainly like a problem like we have to think about as like an ecosystem. So yeah, do you think we're going to be able to like get these everywhere, or is it going to be just a permission section of DeFi?
I think it depends on the specific implementation. Layer Zero is actually already in production servicing permission chain to public chain information passing. And the way OFT works is you deploy OFT contracts on all the chains that you want your token to be native on and enable movement between. So if you're the owner of the contracts, that means you can expand and contract the sort of like native scope of your token. Let's say Layer Zero launches on Linea day one, and right now your token is an OFT on Ethereum and Optimism and Arbitrum. You would just deploy an OFT contract there, and it would immediately hook up and it'd be the same contract address and token ID and maintain provenance across all of these. And you can embed within the OFT contract any kind of like metadata or features, including geofencing, KYC, all of these things. So it just depends on the token issuer. And we're seeing some, or I've been helping out with some experimentation of this. One other instance of OFTs, which is really interesting, is deploying your OFT as native also on something like Avalanche's Evergreen and Spruce subnets, and enabling your native tokens to also be native there, which is now an app chain that most of the large TradFi entities are using. And props to Avalanche for bringing them in and engaging them in this way.
Awesome. Yeah, go for it.
Maybe to jump in. So yeah, I mean, we build those tokens and we issue tokens that are, in the case of Ethereum, plain ERC20 tokens. Yes, it's a permission market on the primary market, but then, they're freely transferable just like USDC. But what we are seeing is, obviously these are security tokens, they're securities. And so you have rules that are specific to those assets and that govern the traditional finance. And what we're seeing, so we've got a bunch of these assets that have been issued, but we're struggling to build liquidity on secondary markets. And that is because people, with the DeFi infrastructure as it currently is, and trading with unknown people and DeFi, you would be instantly like breaking a few laws and rules. AML laws, obviously, but then also like securities rules, specifically like when you're offering securities, you're meant to have a broker-dealer license in the jurisdiction where the investor lies. And so obviously, like if you're providing liquidity on Uniswap, then it's an issue. Like which broker-dealer license? Like how do you put this together? It's really a wall we're hitting right now, and so we're it seems that, you know, at least for now, we'll have to find a way to create permission markets where that liquidity can be safely bootstrapped, and then before evolving, you know, further into permissionless world.
Yeah, if I can try to explain how some other protocols are doing it, like how we look at it, whether it's good or not, it seems like the permission issuance and redemption of a specific token can be gated, can be permissioned, as maybe Matrixport does. An example of this is Matrixport. An example of this is like Ondo OUSG. What we find interesting is that there still are ways to make these permissionless as long as there's a permissioned issuance and redemption route. So, for example, Ondo OUSG is integrated with Flux markets that allows for FUSDC to be minted on top of it. That's permissionless. I'm not the one to say that's good or bad, but it's certainly what's happening. Something like FUSDC can then try to go get listed on a place like Aave, where Index would look at that and go, okay, we can maybe build a strategy. Is that the same process that Matrixport uses to get liquidity onto Curve, or are there other pieces as we like go from origination to tokenization?
At this moment, the Curve pool is a gated pool, so that means all the people who provide or take liquidity from that pool need to be KYC. That is already on the whitelist address. So not really from that regard, but I think some of the application you mentioned, example you mentioned, is very it's a good reference, right? It's whether I think the restriction comes from that this is a STO and there's the restrictions around distributing the STO which need licenses and or very strict reverse solicitation rules. However, if it's not distributing the STO directly but use the security as some sort of underlying for some other assets, which there might be a flexibility around that. So I think that's where everyone is trying to explore.
Yeah, there's certainly like a balance between like we want these things to be permissionless, but in many cases they can't be. So I bring up FUSDC as an example. It's just tokenized treasury bills. We look at something like that as like voters on Aave and go, okay, that's like a very interesting use case for a money market. As like Maker and Spark looks at like tokenized treasury bills, are there criteria you may look at to list an asset like that, or like generally when you look at RWAs on money markets, like what are you guys looking at in terms of like the parameters to set possibly? Yeah, I mean,
I'll speak for Maker because like Spark on the Spark side, we're more focused on DeFi stuff. User Vault, that's more like user Vault land, and actually let me explain that a bit. So when you're backing a stablecoin, there's two places you can put the backing. It's either in protocol controlled value, and this needs to be super safe stuff or else you risk insolvency if it's volatile. So this backing will mostly be T-bills and like AAA corporate debt, basically stuff that looks like cash, but you want to kind of maximize the yield there. Then there's like user vault land, which is you know, ETH collateral vaults, so you can take leverage out on ETH, and this would also apply to tokenized stocks or whatever, tokenized commodities, whatever else. So let me talk about the Maker side because I think that's more relevant, especially with the onslaught of T-bill investment opportunities that have come recently. So for Maker, there's the main trade-offs I would say is liquidity and return. So I think a good example of this is Ondo OUSG and the Flux market. So probably, and this is of course after performing due diligence and stuff like that, we need bankruptcy remoteness is something that Maker is looking for in any investment vehicle. So yeah, by the way, just if you're building these types of things, make sure they're bankruptcy remote because some of them are not, and it's not great. So after performing due diligence and, you know, it seems like a sound investment, nothing fishy, we look at how liquid is it. So what is the redemption time? So if we're to invest into some T-bill investment, how long does it take to liquidate that position if Maker needs to bring the peg back up if it's breaking down? So this is usually a couple of days, but getting this number down as much as possible is a huge advantage for your product. Now, Flux is interesting because it kind of sits more in the middle. The yield is lower, but it's way more accessible to there's idle liquidity there, so you can actually pull liquidity back into the protocol immediately to a certain degree. So it all exists in this trade-off between liquidity, and I would say the most liquid asset is USDC, but there's no yield on it. So it's a trade-off between yield and liquidity, basically, and that's the trade-off that Maker is looking at primarily.
Yeah, understood. I mean, from our perspective, Index Coop, it's like, again, it's good, it's permissionless, but like we need to know how it gets there. We got a cat on stage if anyone wants to ask a question. But yeah, I mean, when you talk about liquidity, and this might be a good question for you, Cynthia, like how much liquidity is enough? Like, is that a question you ask? Like, do you think about like curve bribes? Like, obviously you do. When we look at liquidity, like we certainly have like worst case scenarios of like what could happen if it's illiquid. Money markets probably want multiple areas to like liquidate an asset. So like, what's the liquidity looking like now? Like, where do you hope to be in the future?
Yeah, currently it's between like 16 million to 20 million in that pool. And I think by end of this year, we are quite confident we can get it to 30 to 50 million. And whether that's enough, I don't know, because I think that demand of that, the liquidity demand for that pool is grow in tandem with the DeFi integrations we have, right? The more DeFi integration we have, the more kind of liquidity sensitive they are, the more demand they have on this pool, then we need to find different ways to grow the liquidity there, right? So I think now we are seeing a very healthy, it's the I wouldn't say it's flywheel, but currently we're seeing a very good momentum that the both side is growing. But I think, yeah, we hope that once we get hold of some of the big protocols where they are sitting on billions or hundreds of millions to deploy, then they definitely will need a very strong demand on the deep liquidity on chain. But it's also very much depends on the liquidation mechanism, right? So I think yesterday I was at listening to the first chat of Michael from Curve. I think he mentioned that they have a new mechanism for liquidation where they, out of the $10 that you need to be liquidated, actually they have a way that actually end of the day they only liquidate a small portion of it, maybe $1. I think this is also important. If the efficiency of the liquidation could improve through some sort of a smart algo, then there isn't that much big liquidation need to happen at once. Then that also helps, right?
It certainly helps. Llama is like a huge innovation,
yes,
in my opinion.
Yeah.
Sam, you mentioned Black Thursday. Like if you have an ETH leverage position on Maker and then one day, 24 hours, it goes down 30 to 50%, like that's terrible. That's incredibly risky. And it's like one of those things like we've just have to take for granted. Index Coop builds like managed leverage positions that like would do that automatically for you. But even then, like the volatility within those, just like you'd have to continually rebalance it. So it's certainly difficult. That's why Llama comes out on Curve USD and like super exciting for us. We're talking about liquidity and like how you get liquidity for some of these tokens. Do you think it's all just a yield game? Like I know Stargate has their own problems when it comes to trying to incentivize people to get onto their chain. Like, is this all about yield? Is it about the underlying token? Like, how do we incentivize liquidity for all these different stablecoins?
I also want to say
question.
I unfortunately have to leave in like a minute or so to run to another thing. But with Stargate, Stargate leverages something called the Delta algorithm, which is a proprietary algorithm that handles the accounting across these unified pools of liquidity. And if you guys are unfamiliar, it's a native asset bridge, only native assets, of course, and OFTs. It's sort of just like add, subtract across different chains. I actually think that it is like a yield challenge, but I also think that As I had mentioned before, to bring more liquidity on-chain into this, the actual like packaging and go-to-market of these assets has to bring in net new users as well. And so like designing those user experiences matters a lot, quite a bit. And I think Stargate will play a large role in that. But yeah, unfortunately, I do have to dash. So these four are the best hands to be in. Thank you so much for managing this.
No worries. Yeah, the reason I asked a question about like a yield game is just because like it seems like it sometimes is a yield game in DeFi, but sometimes it's not. We were speaking earlier, like the DSR on DAI, for example, at 3.5%. Like you'd think all deposits of Aave USDC would move directly to that, but it just hasn't happened. Maybe Aave DAI, yes, apologies. Well, Aave DAI, Aave USDT, like you think it'll all move over, but that wasn't the case. Like what role does user experience play in some of these RWA tokens? Like for example, like we build on top of back finance and we go to our users with our new token and hopefully it's easier for them to get into. Hopefully they don't have to KYC multiple different times to get in multiple different positions. But this might be a good question for you, Cynthia. Like what's that user experience like? Is it different for RWAs than it would be for some of the traditional for like Bitcoin or Ethereum? Is that process different to get into these, or do you see like different users having like different type of experiences?
I think it should be as smooth as possible. Now it's probably not the case, right? That's why you are not seeing a lot of users coming in holding RWA yet. But I think there's a lot of improvements you can do regarding the user experience, where they can first get instant swap of RWA once they qualified as a holder, and they do not necessarily need to go through the 3-day, 4-day minting and redemption process. And also there should be way for smart contract to interact with the minting contract, which we are also launched. It's easier for DAO and other like DeFi native protocols to interact with the whole minting process, and while during that process has 100% transparency and visibility on which so the whole process is fully trackable, so that minting smart contract. Yeah, so we try to make it, I think the area that we really, like Matrixport really spend a lot of effort on is really how to make this whole experience and integration very much DeFi compatible. Yeah, because once we are there, we don't want to go back.
Yeah, certainly. Yeah, go for it.
Oh, yeah, I was just going to say, my view on it, having observed the DeFi space for a while, it's I view DeFi people are kind of a little skittish and untrusting of new things, and so why isn't there everybody piling into these higher yielding investments? Quite honestly, I think it's branding and reputation. Like these things are new. People are unsure in a space where, you know, getting rugged is like commonplace. People are naturally worried about the soundness of what they're investing into. So that's also true. But I mean,
why can't we get more institutional money to come into crypto? What's holding them back? Because they're the RWA investors. Why don't they buy tokenized assets? You know, why doesn't Deutsche Bank come in and go to Matrixport? I want to buy your T-bill token.
Yeah, I mean, there's the degen side for sure, but this is my personal observation. You know, feel free to disagree, but yeah, from my view, people are like, okay, these brands, you know, Maker, Aave, Compound, these feel safe, so they park their money there, right? And for better or worse, that's kind of how, in my opinion, the average DeFi user kind of thinks about this stuff. So when newer stuff comes in, and even if it's higher yielding, you're skeptical of these things. So I think it's just it's slow and steady process. As more TVL gets locked into these newer instruments, people will get more and more confident. Like I've heard many times people like, oh, that had high TVL. Why, you know, for example, Euler, it kind of loved the Euler team. It was very unfortunate that they had that big hack, but a lot of people were caught off guard by that because they're like, it's had so much TVL in it. Therefore, it's like very safe. And so, yeah, I just think that's how people think about this stuff, and it'll just be a slow process to ramp up.
just to go back to your question, I think like when you're Deutsche Bank and you have access to the traditional markets, you don't need Matrixport or Backed or to actually get exposure, and you prefer to trade directly on the exchanges. I think we're more about like giving access to people, entities that don't currently have that access to traditional assets. I think that's where the game is right now. Potentially further down the line.
What people, when you refer to people and entities, what do you give specific protocols specifically?
So people in I don't know, let's say Latin America, South America, Africa. Well, yes, and then crypto native entities.
So crypto native, and so I'm a crypto native entity. We have a treasury. I can get into access to these bills. I think those protocols can get access to that. Right?
So what are you invested in?
I'm invested in terms of everything.
Your treasury, like what is it
I
mostly?
don't touch T-bills. I don't want to. Why would I take my crypto money that I've worked so hard to build an ecosystem?
Are you in ETH then?
Crypto. I'm in ETH, I'm in Bitcoin, I'm in,
Okay.
you name it, Solana, all the layer 1s, layer 2s, ARB, everywhere.
When your treasury is volatile, you don't have.
Oh, of course it is. Yeah, you have to balance it. I also have stable coins in there, yeah.
So
That's exposure to T-bills.
That's just as much an RWA as. It's
So
just a
you
different
consider
path.
stablecoin
Oh, I
RWA.
mean, certainly USDC is backed
So
maybe by
LUSD,
treasury
would
bills.
that be,
You just don't get the extra yield that we're talking about here.
I want to share a little bit my view on this. Actually, I ask we ask internally the same question: whether in the future the TradFi big boys will join our market, and I think they will. The reason I think they will, of course, at this moment, I agree with Erwan and I agree with Sam that the current demand mainly coming from the crypto native guys, people not having access to the TradFi products, and they might be the first batch users, but I don't think this is the end game. I think the end game is there's going to be a toppling effect, and that tipping point will happen when you have significant on-chain activities, right, in our markets, and there is a significant participation from this world, and the superior efficiency of the DeFi infrastructure, which 24/7, more inclusive, lower cost, would once you have that traction, there will be a tipping point where they see, okay, what's happening here, and the more efficiency, and also the arbitrage opportunities that exist in this 24/7 pool of the treasury bill trading market that we build on Curve versus they only trade a few hours and then they don't trade on weekends and bank holidays in the US. There gotta be a moment that they feel interested about this and start to dabble into this world. And then they try and play out and they see, okay, it actually makes sense and to do more. And it helps because this is a permission market. They do not have all that bank kind of risk officer giving you questions about the KYC and who you are dealing with, AML issues. So I think that will happen. It's just that will happen in stages. That's why we do hold a long-term confidence in building in RWA.
Fundamentally, like crypto rails are much better suited to financial transactions than the legacy system. And it will take time, as Cynthia just said, but it's just a matter of time before that it happens.
Yeah, and I think you saying that your treasury was a lot in ETH. I think so. To clarify, I'm talking about those who are holding stable coins getting zero yield. Why are they not transitioning? I understand holding ETH Bitcoin is an entirely different discussion. So there's obviously different risk profiles with each, but those who are holding stable coins right now, say USDC, getting zero yield, why are they not getting these into these higher yielding investments with the same underlying backing? That's my point.
Yeah, it brings up an interesting question, one that I wanted to ask. You kind of front run us on there, which is great. How do we get from, so like Backed, it builds on top of BlackRock ETF, for example. How do we get from a tokenized wrapper on top of the traditional legacy system to actually originating some of these assets on chain, like taking advantage of all these efficiencies?
Right. So, I mean, yes, we're just an add-on to the existing system, where, as you said, like a wrapper to those products. Eventually, further down the line, will get issuers to natively issue on chain. And yes, potentially like the Deutsche Banks of this world will push their clients to do so because of efficiency and liquidity features that crypto offers. I think we're in that interim stage where we have to bridge those two worlds, before those issues come natively on chain. I think right now it's still very complex, and those issuers don't see the benefits of doing so as well.
Yeah, in my mind, it's certainly too risky for them at this point to even try. It's like part of some of the conversations we have with our institutional team at Index. It's like we could do this, but really, what's the upside for us? I think that upside will be clear in the next hopefully 5 years or so. But yeah, like the liquidity, the instant liquidity, instant redemption of some of these things is incredibly important. The efficiency of using AMMs, the efficiency of using money market protocols, things like Llama that allow you to only get partially liquidated. We do think that's like enough. To me, in my opinion, that's why we're building these things. So like, why wouldn't that extra layer come on top once traditional teams are in this? But yeah, it again brings up like an important topic. Like, what does this look like in 5 years? Like, I was just looking at RWA at XYZ. We have like 630 million in treasury bills on chain. Some traditional finance teams are building those. Some non-traditional crypto teams. RWA is obviously much bigger than that. Like we talked about real estate. Like, what is this going to look like in a few years? What's it going to be like? Like, we can't be calling it RWAs in 5 years, hopefully. Did you guys have an opinion on that?
Sure. I mean, just at Backed, we're going to try and we will bring many assets on chain from different asset classes. Equities. We already have like an S&P 500 token, but yeah, equities, fixed income, obviously, commodities, real estate, you name it, maybe art. That will come on chain, and within each asset class, if you take fixed income, for example, we'll be able to offer products within different currencies: dollar, euro, JBP, and different types of issuers, government bond, like govy bonds, corporate bonds, short duration, long duration. Again, to try and offer a wide panel of tools for players and people to really do better financial management of their money. I mean, I think yes, the space it's growing, like the RWA space is growing, but it's still really tiny. When analysts are throwing numbers like 4 or 5 trillions will get tokenized in the next 5 to 7 years. It's definitely a possibility, and yeah, we're just scratching the surface here.
Yes, yeah, agree. I think just want to share 2 observations. I'm based in Hong Kong. Hong Kong is a financial market. I used to work in TradFi. I used to work at Hong Kong Exchange 5 years ago before I joined crypto full time. So I recently, this year, has had a lot of conversation with the TradFi people, and every one of them is mentioning RWA. All the big asset managers, all the big broker dealers, they are talking about RWA. I think some of them even have internal teams really working on that. You don't really see that for crypto. For crypto, it's a different narrative, right? Last bull run, because the price goes up so much and they might have some end client requirements, they were kind of FOMO'd into the space, right? They wasn't really sure about what crypto is, but they were like, okay, maybe there's a demand, our client is asking for it. They will get pushed into the space. That's how last bull run happens. But this time I feel it very differently. I feel they are leaning forward very much to get into RWA, probably even more eager than us, right? Because they already have the asset, they already have the distribution, they have the brand, they have the licenses, everything, right? So they also feel that, okay, this is a game changer for them. So it's the first time in the history of crypto that you see the two forces are going to join somewhere very soon in the near future. So my estimation of the scale of this is phenomenal. I think in the 5 years time, there are going to be tens of trillions of market cap, new market cap brought in by real world assets. And that's probably going to be a very significant part of the digital asset world, right? So our industry is no longer going to be called crypto industry. It's going to be called digital asset industry.
Yeah, I mean, are we going to be able to change the name RWA in 5 years? I don't know. A lot of people seem to be trying, but names tend to stick from what I've seen. Anyways, yeah, 5 to 10 years. I view, you know, TradFi, DeFi, it'll just converge into finance and everything will be on chain. Tokenize everything at the edges in very Lego blocksy atomic units with independent auditors at every step. And then you have everything on chain and liquid secondary markets, and ideally as permissionless as possible. But, you know, I understand there's probably going to need to be some permission segment. But striving for permissionless as the goal is the world I would like to see. Yeah, I think that's roughly my view of it.
Yeah, I tend to agree. Yeah, I think you brought up a good point, Cynthia, of like the way we look at it as crypto people is totally different. Like if you go to a conference that's a bit more TradFi focused, maybe like you'll hear, like 6 months ago, I heard like Bank of New York Mellon talking about like bringing the assets that are illiquid on their rails and bringing that to crypto. That's totally different than talking about treasury bills on chain. So yeah, I do agree. I mean, like Franklin Templeton has their RWA product that's just T-bills. Like I see a world where they're going to bring all of their products on chain because of the efficiencies. I think we can keep talking forever. That's about all I have. Certainly very happy talking to you all about this. We hope you guys keep building products that IndexCoop can integrate. But yeah, I think hopefully in the 5 to 10 years we'll all have TVLs on our protocols that are much bigger than we have today. But yeah, thank you to all the panelists, and hopefully we continue talking.
Thank you.